Hey, how's it going? Bill Lethman here for Money Evolution. In today's video, I'm going to be doing another episode of eMoney Mondays, and we're going to be talking about whether or not you have, or how to determine if you've got too much money in your traditional retirement accounts. Why is that an issue, and why is that something you should be concerned with potentially? Well, it's because the money that you have in those traditional retirement accounts is money that hasn't been taxed yet, and it's going to be taxed along the way as you start to withdraw that money in retirement. But for many people, you might have, let's say, too much money in those accounts, if that's ever really a thing, but it's going to be too much money in terms of the potential taxes that you might have to pay, because you can't leave that money in those accounts tax deferred forever. Eventually, the IRS is going to start making you take some money out along the way, and that's going to be part of what's called your required minimum distributions. And depending on what year you were born, if you were born in 1960 or later, your required minimum distribution age is going to be age 75, and if you were born before 1960, your RMD age, or required minimum distribution age, is going to be age 73. And that's something that recently changed a couple of years ago with the Secure Act 2.0. So what many people may find is that a combination of two things. One, the amount of money that they currently have in their traditional retirement accounts, maybe the rate of return a little bit if you've done well as an investor and that money's growing a little bit faster. And depending on how much money you're withdrawing from that account on an annual basis, those balances could start to be a much bigger deal, and then those RMDs could push you up into a higher tax bracket later in life. So this is something that we generally want to try to address before we get to that age 73 or age 75. But even if you're at that age, there's still some things that you could potentially do that might be able to bring that down a little bit. All right, so we're going to jump into our eMoney financial planning software here, and we've got one of our hypothetical client plans up here on the screen, Steve and Kelly Sanderson. They're age 64 and 62, respectively. They just went into retirement here, so we're going to assume this is in 2025, year one of their retirement. We can see, looking at their cash flow, everything looks good. Plenty of money to last them throughout the rest of their lifetime in things. We can see what their withdrawals potentially are from the retirement plan. I'm not going to get into all of those details, but from this cash flow report, one of the things that we see is their plan distribution. Now, we can build out a plan. That's something we do with our clients. We can build out and map out all of the retirement withdrawals inside the software here, but this is going to be the IRS plan. This is going to be the minimum distributions. If we click on it, because there's about a 2-year difference in their ages between Steve and Kelly, we can see Steve's got a couple of IRAs and a 401k, and then Kelly has her 403b plan, and we can see what those RMDs are going to be. And as we go through time, we can see that even in just year one of their RMDs, it's going to be $275,000. That's the projection. That's going to be based off, again, what the withdrawals are from those retirement accounts, from those traditional accounts, and it's also going to be whatever growth we have. And again, those are a couple of things that we don't necessarily know, but we're going to put some forecasts together based on some reasonable assumptions here. But we can see what happens later on in their life. That gets up over 400,000, 500,000, even 1 year here gets over 600,000. That's going to be their RMD that's going to be added to all of their other income. Now, Steve and Kelly, they have done very well. I think that overall they've got about $7 million of total investable assets here. If we look at their net worth statement here, and about $4 million of that is going to be in those traditional retirement accounts. So again, your situation may be different, and even if it is significantly less than this, you could still have some of these same issues or concerns, but we may be just talking about a slightly different tax bracket. Instead of maybe talking about one of those upper brackets like we are for Steve and Kelly, we could still be talking about those RMDs pushing you up from, let's say, a 15% tax bracket to a 25% tax bracket. So let's hop over to one of our plans in the Decision Center here, and what we're going to see here is we're going to see the initial mapping, if you will, of what that tax bracket looks like over time. And something I've talked about in many other videos, and I'm going to talk about here again today, is those low tax years in the early part of retirement. And for many people, that really offers one of the best tax planning opportunities if we want to really start to optimize this, do things like Roth Conversion and things like that. But we can see in those early years, because they do have a significant amount of money or assets in those non-retirement account balances, they can pull money from there essentially to live off of in those first handful of years in retirement. So they may only be really in about a 10 or 15% tax bracket. And then what we see here is right here in 2036, kind of zoom in that a little bit, we can see that their tax bracket jumps all the way from 15% to 28%. You know, pretty big deal there. And even later on, as those assets maybe continue to grow, that even gets up into a 33% tax bracket. Now, one of the things that we know today is in 2025, we are on the last year of the Tax Cuts and Jobs Act that went into effect in 2018, and they are set to expire that particular tax package at the end of this year. So we're going to be looking hopefully for some type of an extension. I know Congress is working on that right now. We're pretty hopeful that we're going to see something coming out here maybe in the next 3 to 4 months or 5 months, and maybe see that new tax package, and hopefully it will at least be an extension of the current tax rates. It might even go a little bit lower, or it may have a little bit more of a divide. There's a little bit of debate going on, I think, in Congress right now, but we might see tax rates come even lower on people with incomes maybe under 200,000 or under 400,000, but we might even see a little bit of a tick up potentially on people above 400,000, or maybe it's going to be over $1 million. But I know that's something that may or may not happen, but we're looking to see maybe a reduction in some of those lower tax brackets, which would be absolutely fantastic here. And I just did a quick little hypothetical here and just said, hey, if we wanted to look at one of those Roth conversion scenarios, this is going to be a very basic one. And I think all I did here was told it to fill up the 15% tax bracket, which should be some very low-hanging fruit in the early part of retirement. And we can see the kind of benefits that you might be able to have as doing a Roth conversion, and you know, basically taking advantage of the lower tax brackets that you have maybe in the early part of your retirement, and then it brings down some of the taxation later. So in this particular case here, just doing some Roth conversions looks like about $100,000 a year for maybe the first 6 or 7 years of retirement. Drops off a little bit there, and they're basically doing those Roth conversions just up to the point where Steve hits that RMD age at age 75. But what it did is it reduced their total taxes calculated over their lifetime based on the assumptions in the plan by over $304,000. It also increased their total portfolio assets by nearly $500,000, $469,000. And I'm sure this video is not intended to be a Roth conversion video, but if we continue to refine this, maybe we can even extend some of this out a little bit more, that type of thing. You know, maybe go a little bit more aggressively, see what it looks like if we went up into the 25% tax bracket. I didn't want to go there yet because, again, later this year, hopefully we might see that tax package come through, and that would certainly give Stephen Kelly, in this hypothetical example, that opportunity to do some more aggressive conversions here. You know, as we do these eMoney Mondays, you know, the goal is to, you know, really just give you some ideas on some of the things that you should be thinking about with your financial planning, and really, I think, illustrate the point that a lot of this stuff, if you're really looking to optimize your total financial picture, your retirement plan, really get into the details on taxes and things like that. I'm going to show this other tax report so you can see sort of the types of detail that we have inside of this software here. This is the eMoney financial planning software. But when we get into things like a regular federal income tax, we can see, you know, just all the detail, the total income, what is the adjusted gross income. I mentioned just a couple of minutes ago that Stephen Kelly, in this example, have some money in those non-retirement assets. Well, they have a very low cost basis relative to those assets. I think we put in there $2.2 million as the total of non-retirement accounts with a $1 million cost basis. So every time they sell something, they're likely going to be incurring capital gains. But one of the things that many people may not realize is that those capital gains are taxed at a preference rate as long as it's long term. Same thing with qualified dividend income. So we can see that they have taxable income, for example, of $157,000. Their total income was $194,000. So we're calculating the standard deduction and then the amount that's taxed at that preference rate, but their income tax base, because all of that money to fund their lifestyle expenses is coming from that non-qualified portion of their assets, that's not going into the tax brackets at all. They're basically starting from zero there. So when we start doing those Roth conversions, now we can fill up a tax bracket and do those more aggressive Roth conversions. And that just gives you a little bit of the idea. So as you start really getting into the detail, to really hone it in, dial it in, and get the most out of your money that you have for retirement and make sure that you're not leaving anything on the table, you really need to have some software. I think eMoney is the best software out there. I've been using it for, I guess, about 16 years now, and eMoney's done a great job of continuing to upgrade the software, continuing to improve and come out with new enhancements and things like that. So it's really been very helpful for us and for our clients. If you want to learn more about what we do with our financial planning, you can head over to moneyevolution.com. Check out the Money Evolution plan, which is our top level, high-end comprehensive plan that you work with us one-on-one through a series of 4 meetings to build out your plan. But we also have a great program called the Retirement Time Machine, which is a little bit, it's the same exact software, but it's a little bit of a DIY type of experience. We have a great video library to really educate you on all these different topics, to show you how to get into the software, use the portal, make updates and changes, and we do include one-on-one meeting with our team here to go through the plan and evaluate, and then there's some other opportunities. We have little office hours and things like that that come along with it. So anyway, check out that below. If you haven't already, be sure to subscribe to our channel, and we'll see you in our next video. Thanks.